Welcome to this short executive knowledge lecture on Topic 1, Paper 12 of the SFC licensing exams. This topic covers an overview of the asset management industry and serves as a backdrop to the topics that will follow. I will emphasize the important points to help you understand the core material you need to know to sit the exam, and a copy of the study notes you see on the screen can be downloaded from the Executive Knowledge website under Resources for Paper 12. Now, I strongly recommend that you supplement this learning with question practice, because to prepare for the SFC licensing exams, you're really building up your short-term memory with knowledge of the underlying concepts. And question practice positively contributes towards this. And we have many questions on all 4 topics of Paper 12 on the platform Examinator.online. And you can see it referenced at the bottom of each page of these notes. Right, let's have a look at what is in Topic 1, the overview. And you'll see we start off with an overview of fund management and managed funds. We then consider the difference between retail and institutional managed funds. We then look at the different participants in the fund management industry, and you can see them listed there on page 1.1, investors, promoters, fund managers, etc. And then we will lastly, under topic 1, look at the different channels that are used to distribute the fund management products. Okay, let's get into the material. And we start with the overview of fund management and management funds. And I'm going to read through the definitions under 1.1 to get us started. This is important for an overall understanding of what we're looking at, but also they could pick it up in a question. So starting with asset management, that involves the professional management of financial securities and or real properties, and we're going to come across these 2 categories in a moment, by financial service provider for various clients, investors, and we'll look at the different types of clients shortly. Now, the Securities Futures Ordinance, the main piece of legislation in this area, defines asset management as real estate investment scheme management or securities and futures contracts management. Now, the first one is the world of REITs, and the second one is the classic major area, securities and futures contract management. Now, asset managers who offer products to the Hong Kong investing public or managed funds on a discretionary basis, if you're involved in either of those 2, you must hold a Type 9 license for asset management. And we're told the Asia-Pacific region has experienced significant growth in funds under management with the expansion of sovereign wealth funds, pension funds, and family offices. So in the Asia-Pacific region, fund management has only grown over the years. Now, what are managed funds? They're indirect investments known as collective or pooled investments. We'll talk about collective investment schemes later. Investment funds or funds. So these are terms that we use for managed funds. Types of managed funds offered. We've got unit trusts, mutual funds. These are the 2 big ones that are offered publicly. Retirement or corporate funds, hedge funds, private equity funds. So the big 2 are the first 2, and then the other 3 are referred to, but not in as much detail. And we say effectively the individuals delegate management of their money to professionals who exercise investment discretion. Therefore, these funds are known as discretionary investments. Now, the background of fund management industry in Hong Kong, since the 80s, Hong Kong has attracted financial institutions year after year from UK, US, Canada, Europe, and that will, I'm sure, move into China as well. Now, the major code that the SFC has issued in this area is the Code on Unit Trusts and Mutual Funds, and that came in 1978. And that's when Hong Kong was a fledgling financial centre. And in those days, one firm was leading. It's now part of JP Morgan, but that was Jardine Fleming. Influx of all these investment fund managers were attracted by the appeal of Hong Kong. Why? A central location in Asia region, clear regulation covering local market authorization, and just and equitable legal system. It continues, and this is material that can be examined. I've seen questions on this. It's attractive because of the widespread use of English, experienced administrators, simple low rate tax system, the proximity to China, that's becoming even more important, world-class communication systems, stock market liquidity, and the fact that there are accountants, lawyers, stockbrokers supporting the fund management industry. Please be aware of these positive aspects of Hong Kong as a fund management center. One question, but it has come up. Okay, 3 categories of the industry: institutional investors. These are the big ones. Active fund management companies. We also have passive fund management companies, insurance companies, banks, sovereign wealth funds, endowment funds, corporate treasury management, retirement schemes. MPF and ORSL will come to those a little later. So these are the big institutions managing money on behalf of clients. We then have retail investors who are investing on their own behalf. Individuals, less sophisticated needs than the institutional investors, less complex objectives. Well, usually they just want to make money, grow their investments. And they tend to be attracted to unit trusts and mutual funds, which are made publicly available. And as we'll see later, any funds that are made publicly available must be authorized by the SFC. And the 2 major categories, unit trusts and mutual funds. And then the third category of the industry is private clients, individuals, wealthy individuals. They may set up family offices, and Hong Kong Monetary Authority has defined private banking customer. Now, this material came in just a few years ago. Defined private banking customer to cater for operational needs of private wealth management institutions as a customer with either at least $1 million of asset under management, so that's 7.8 million Hong Kong, or assets, total investable assets of at least $3 million. So that's a definition put forward by the Hong Kong Monetary Authority. And high net worth individuals are usually considered to be individual professional investors. Now, what about protecting the elderly, the retirement funds? Well, in 1994, we're told that the World Bank recommended a 3-pillar approach. Now, which pillar did Hong Kong go for? Well, first of all, a publicly managed, tax-financed social safety net for the old. So that's one way of protecting the elderly, and that's an approach that the UK took many years ago. 2, a mandatory, privately managed, fully funded contribution scheme. That's the option that Hong Kong went for in 2000. That is the mandatory provident fund scheme setup. And then voluntary personal savings insurance. Well, that's all down to us as individuals. Now, different types of managed funds. Unit trusts, mutual funds, umbrella trusts on page 1.4. Now, the difference between unit trusts and mutual funds is very important for the exam, and this is an easy area to set questions. What is a unit trust? It's a managed fund where the trustee holds assets on behalf of the beneficiaries, and it holds for the benefit. So this is usually a bank that will hold the invested assets on behalf of the beneficiaries. The trustee owes a fiduciary duty to the unit holders. So it's a unit trust, you invest in units. Trustee obliged to buy back units from unit holders. So if a unit holder wishes to redeem, then the trustee obliged to buy back, and the units are valued at net asset value. On the other hand, mutual funds, similar to unit trusts, but they're set up as a limited company. Now, there is a table for comparison between unit trusts and mutual funds. Please read through that and familiarize yourself, because there's a very good chance a question will come up testing you with regard to the difference between unit trusts and mutual funds. We have umbrella trusts, 1.33. These are master trusts offering broader set of investment options with access to managed portfolios. Two types, discretionary trust and fund of funds. Let's look more detail at those two types. The discretionary, or the umbrella funds, single legal entity operating as a collective investment scheme. Remember, I referred to that earlier. Several distinct sub-funds trade as individual investment funds, and clients can choose different sub-funds. So these are particular funds with sub-funds, and you can choose the ones you wish to invest in. Whereas a fund of funds is a fund that invests in other investment funds, provides cost and administrative efficiency to investors, because the investors don't have to go choosing the different funds. That's done for you. While widely used in the managed provident fund schemes, which we're going to consider in a moment, and they're technically called unit portfolio management funds, but I wouldn't worry about that point. Okay, so what about mandatory provident funds? As I said, they came in December 2000, and this was a safety net. Retirement scheme for all employees in Hong Kong. Now, previously, there was private schemes set up by companies known as ORSO, Occupational Retirement Schemes Ordinance schemes, but these now tend to have faded away with the MPF schemes now in the ascendancy. Different types of MPF schemes. We've got master trust scheme, an employer-sponsored scheme, and an industry scheme. Read through the different descriptions. I could pop up as a question, but I would say it's probably more peripheral. And the last bullet point under 134 tells us that all MPF schemes must include a standardized low-fee default strategy, known as default investment strategy. Now, that can kick in as investors get older, get close to retirement age. They may wish to move to that type of strategy. Now, we have a difference between onshore and offshore funds, and this is all to do where the fund is domiciled. If the fund is domiciled in Hong Kong, it's an onshore fund. And if it's domiciled outside of Hong Kong, it's known as an offshore fund. And we have some tables on page 1.6 showing us percentages of the domicile of Hong Kong unit trust business. And we can see there that Hong Kong and Luxembourg are two major domiciles for funds in Hong Kong, or that are dealt with in Hong Kong. You've got Ireland, significant amount there. The one that people often associate with fund management is the Cayman Islands, but you can see that it's a very small percentage of Hong Kong unit trust business is domiciled in the Cayman Islands. Well, why are offshore funds popular? Well, three reasons: the tax benefits of offshore funds, as they're incorporated and popularly known as tax havens, so there's a tax benefit; economies of scale by being close to large markets; and lower level of regulation. What about the size and the different sectors in the fund management industry? Well, we see that the two big ones are public funds and managed accounts. Then we have private funds, the MPF scheme and ORSO funds, a lot smaller, and then just generally other funds. Now, page 1.7, reasons for industry growth. Why is the fund management industry experienced significant growth in Hong Kong over the years? Well, there's many reasons, and the ones that are given in the study manual: access to the ever-growing regional opportunities, especially the emerging China market; local asset management talent, and that has been growing; leading renminbi offshore center; free flow of capital in and out of Hong Kong, that's always been the case; products launched under renminbi qualified foreign institutional investor. Now, we'll look at a bit more at those later, but these are institutions outside Hong Kong that are able to invest in China products. Stock Connect, Bond Connect with mainland China, that's forever growing. Mainland Hong Kong mutual recognition of funds, that came in a number of years ago, where the two regulators mutually recognize each other's funds, and the growth of mainland related financial institutions that are operating in Hong Kong, and that has been accelerating over the years. And we're told that other reasons for the continued growth in the industry: demand for diversification, which funds provide; the better understanding of mutual funds, and education initiatives, so that investors, instead of just investing in individual stocks, are more attracted to the funds that are managed by professionals.